Investing for Beginners, a simple guide to growing your money fast. Audiobook. Introduction. Your journey to growing your money starts here. Written by Peter A. Saul, published by Audiobooks LOA. Hello and welcome. Perhaps you're listening to this because you have some money saved, maybe sitting in a standard bank account, and you feel like it should be doing more. Or maybe the whole world of investing feels like a complicated puzzle, full of jargon and risks you don't quite understand, leaving you feeling a bit overwhelmed, maybe even a little stuck. If that sounds familiar, you're in the right place. And you're definitely not alone. I'm your guide for this journey. Think of me not just as someone who understands the technical side of investing, which I do after years of navigating these markets and helping others find their footing, but more importantly, as a mentor. Someone who's been where you might be now, who understands the questions and the hesitations. I've navigated these waters, and I'm here to show you the clear, simple paths forward. My goal isn't to impress you with complexity, but to empower you with clarity. This audiobook, Investing for Beginners, a simple guide to growing your money fast, is designed specifically for you, the person starting from square one. We're going to demystify investing, breaking it down into understandable pieces. We'll provide actionable steps you can take, not someday, but soon. And throughout this process, we'll build your confidence, replacing uncertainty with understanding. Let's be direct. Investing can seem complex, and yes, there are risks involved. It's natural to feel hesitant. But here's the reassuring truth. Understanding the fundamentals makes it manageable. It's not about being a Wall Street genius. It's about learning a few core principles and applying them consistently. Now, let me be equally direct about expectations. This isn't a get-rich-quick scheme. If you're looking for secrets to overnight millions, this isn't the audiobook for that. What we will focus on is steady, sensible, long-term wealth building, the kind that can genuinely change your financial future over time. It requires patience and discipline, but it is absolutely achievable. It includes checklists, summaries of key concepts, a glossary of terms we'll cover, and helpful links. You'll hear me mention it throughout our journey. Think of it as your handy reference guide. You can find the download link in the audiobook description. So, what's ahead? We'll start with the why, understanding the crucial reasons to invest beyond just saving. Then, we'll explore the basic building blocks, the different types of investments like stocks, bonds, and funds. After that, we'll get practical. How you actually start investing, opening accounts, and making your first choices. Finally, we'll focus on building a simple strategy and developing the mindset to stay the course for the long haul. All I ask from you right now is an open mind and a willingness to listen actively. Let go of any preconceived notions that investing is not for you. It can be, and hopefully, by the end of this audiobook, you'll feel equipped and ready. Let's take the first step together. We notice that 72% of you who listen to our video are not yet subscribed to the channel. Please help support the channel by hitting the subscribe button and like the video. Thanks for inspiring us to create more content for you. Now let's begin. Part 1. Why invest? Understanding the fundamentals. Chapter 1. Beyond saving, why investing is crucial. We all know saving money is important. It provides security, a buffer for emergencies, and helps us reach short-term goals. But saving alone, especially over the long term, often isn't enough to truly grow your wealth. Why? There's a silent force working against your savings. Inflation. Think of inflation as a slow leak in your money bucket. Each year, the general cost of goods and services tends to go up. That $100 you tucked away buys a little bit less next year, and even less the year after that. Over decades, the purchasing power of your saved money can erode significantly. If your savings are only earning minimal interest in a standard bank account, often less than the rate of inflation, you're effectively losing ground. That's Why I sometimes call inflation the silent wealth killer. It works slowly, almost invisibly, but its impact is profound. I remember realizing this myself early on. I was diligently saving, but the math just wasn't adding up for long-term goals, like retirement. My savings weren't growing. They were just sitting there, slowly losing their potency. This is where investing comes in. Investing isn't just about parking your money. It's about putting your money to work with the goal of earning a return that outpaces inflation and potentially grows significantly over time. It's about transitioning from simply accumulating money to making that money generate more money for you. So the key takeaway here is simple but crucial. Saving is essential for stability and short-term needs, but investing is the engine for long-term financial growth and achieving goals that require more than just setting money aside. It's how you fight back against inflation and build real, lasting wealth. Chapter 2. Taming the Fear. Mindset Matters Most. Okay, we've established why investing is important, but for many beginners, the next hurdle isn't practical, it's psychological. Does any of this sound familiar? Investing is too risky. I could lose everything. It's too complicated. I don't understand it. I don't have enough money to start. It's natural to feel hesitant, even fearful. We work hard for our money, and the idea of putting it at risk can be unsettling. The financial world often uses intimidating jargon, and news headlines tend to scream about market crashes, rarely highlighting the long, steady climbs. Let's address these fears directly. First, risk. Yes, investing involves risk, but risk isn't always what people imagine. While the value of investments can go down in the short term, history shows that over the long term, think 10, 20, 30 years, diversified investments have tended to grow significantly, overcoming those temporary dips. The real risk, often overlooked, is the risk of doing nothing and letting inflation erode your savings. We need to shift our perception of risk from short-term fluctuation to long-term opportunity cost. Second, complexity. Investing can be complex if you want it to be, but for beginners, it doesn't have to be. Simple, proven strategies exist that don't require deep market analysis or constant monitoring. That's what we'll focus on in this audiobook, keeping it understandable and manageable. Third, not having enough money. This is a common misconception. You don't need thousands of dollars to start. Many platforms allow you to begin investing with very small amounts, sometimes even just $5 or $10. The key is to start even small and build the habit. Consistency is far more important than the initial amount. I've seen people paralyzed by waiting until they have a significant sum, only to miss out on years of potential growth. What's really holding you back? Take a moment to reflect. Often, it's these mindset blocks. The most crucial step is to acknowledge these feelings, but decide not to let them paralyze you. Approach investing not as a gamble, but as a learning process. Commit to understanding the fundamentals, starting small, and focusing on the long game. Patience and a willingness to learn are your greatest assets here. Recognize your potential mindset blocks, acknowledge them, and then commit to moving forward with a learning mindset. That's the foundation upon which successful investing is built. Chapter 3. Setting the Stage. Your financial foundation. Before you dive headfirst into investing, it's crucial to have a solid financial foundation in place. Think of it like building a house. You wouldn't start putting up walls before ensuring the foundation is strong and level. Investing without this foundation can lead to stress and potentially force you to sell investments at the wrong time. So, let's be direct about the prerequisites. There are 3 key pillars. First, let's talk budget. You need a basic understanding of where your money is coming from and where it's going. This doesn't mean tracking every single penny obsessively, but you should have a handle on your income, essential expenses, and discretionary spending. Why? Because investing requires having money available to invest consistently. A budget helps you identify that money. If you don't know where your money goes, finding funds to invest regularly will be a constant struggle. Second, managing debt. Specifically, high-interest debt like credit cards or payday loans. The interest rates on these debts are often incredibly high, far higher than the returns you can realistically expect from investing, especially in the early stages. It usually makes more financial sense to aggressively pay down high-interest debt before you start investing significantly. Think of it this way. Paying off a credit card charging 20% interest is like earning a guaranteed 20% return on that money, something very hard to achieve consistently through investing. Low-interest debt, like a mortgage or some student loans, might be a different story, but tackle that high-interest debt first. I always advise clients to secure this foundation first. It removes a huge potential burden. Third, the emergency fund. This is non-negotiable. An emergency fund is typically 3 to 6 months' worth of essential living expenses kept in a safe, easily accessible place like a high-yield savings account. We'll touch on those later, but note they are savings, not investments. This fund is your safety net for unexpected events like job loss, medical bills, or car repairs. Without it, if an emergency strikes, you might be forced to sell your investments prematurely, potentially at a loss, just to cover costs. Your emergency fund protects your investment plan from life's curveballs. So, your action takeaway here is clear. Assess your current situation. Do you have a basic budget? Are you burdened by high-interest debt? Have you established an adequate emergency fund? Be honest with yourself. Address any gaps in this foundation first. It's the responsible, stress-reducing way to begin your investing journey. In the companion PDF, I've included links to some helpful resources for budgeting and debt management strategies. Get this foundation secure, and you'll be ready to invest with much greater confidence. Chapter 4. The magic ingredients: risk, return, and compounding. Now that we've covered the why and the essential groundwork, let's explore the fundamental concepts that drive investing. Understanding these core ingredients, risk, return, and compounding, is key to making informed decisions. First, let's talk about risk. When we say investing involves risk, what does that really mean? Simply put, it's the possibility that an investment won't perform as expected, and you could lose some or even all of the money you invested. Different investments carry different levels of risk. Generally, investments with the potential for higher growth also come with higher risk. Next, there's return. This is the profit or gain you make from an investment. Return can come in different forms. For example, through appreciation, the value of the investment increasing over time, or through income, like dividends from stocks or interest from bonds. The goal of investing is to achieve a positive return that ideally outpaces inflation. This leads us to the crucial risk-return trade-off. This is a fundamental principle. Generally, to achieve higher potential returns, you must be willing to accept a higher level of risk. Conversely, investments perceived as safer typically offer lower potential returns. Think of it like climbing a ladder for a better view. The higher you climb, more risk, the better the potential view, higher potential return, but also the further you could fall. There's no free lunch in investing. You typically don't get high returns without taking on some level of risk. Understanding your own tolerance for risk is vital, and we'll revisit this when discussing strategy. Now, for the powerhouse of growth, compound interest, or more accurately, compounding returns. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. Compound interest is simply earning returns, not only on your initial investment but also on the accumulated returns from previous periods. It's like a snowball rolling downhill. It starts small, but as it rolls, it picks up more snow returns, getting bigger and bigger at an accelerating rate. This is why starting early and investing consistently, even with small amounts, can be so powerful over the long term. Compounding needs time to work its magic. Those small, steady gains reinvested over years and decades can lead to truly substantial growth. It turns investing from a linear process into an exponential one. And let's quickly revisit inflation here. Remember the silent wealth killer. Compounding is its natural enemy. Your goal is for your investment returns, amplified by compounding, to significantly outpace the rate at which inflation erodes your money's value. So, to recap, risk is the possibility of loss. Return is the potential gain. The risk-return trade-off links the two, and compounding is the engine that dramatically accelerates growth over time. Grasping these fundamental relationships is essential as we move on to explore specific investment options. Appreciate the long-term power of compounding. It's the most important ally a beginner investor has. Part 2. What can you invest in? Decoding your options. Chapter 5. Owning a piece. Understanding stocks. All right. Let's start decoding the different types of investments available. Perhaps the most commonly discussed are stocks, also known as shares or equities. So what exactly are you buying when you buy a stock? Simply put, buying a stock means you are buying a tiny piece of ownership in a publicly traded company. Imagine a large, successful company, maybe a tech giant, a major retailer, or a big bank. When you buy shares of its stock, you become a part owner, a shareholder in that business. Think of it like owning a tiny slice of your local pizza shop. If the pizza shop does well, makes profits and grows, the value of your slice might increase. If it expands and opens new locations, your ownership stake becomes potentially more valuable. Stocks work similarly, but on a much larger scale. How do you make money from stocks? There are generally two ways. First, through appreciation. If the company performs well, innovates, increases its profits, or is simply viewed favorably by the market, demand for its stock may increase, driving up the price. If you sell your shares for more than you paid, that's a capital gain or appreciation. Second, some companies distribute a portion of their profits back to their shareholders in the form of dividends. These are typically cash payments made regularly, like quarterly. Now remember the risk-return trade-off we discussed? Stocks historically have offered the potential for significant growth over the long term, often outpacing other asset types. However, they also come with higher risk. Company fortunes can change, industries can face challenges, and overall economic conditions can impact stock prices. Stock prices can be volatile, meaning they can go up and down significantly, sometimes rapidly, especially in the short term. It's possible for a stock's price to fall below what you paid for it. For now, the key takeaway is this. When you buy a stock, you're buying ownership in a company, hoping to benefit from its future success through price appreciation and/or dividends. While understanding that this comes with inherent risk due to market and business fluctuations, we won't get bogged down in complex market analysis here. The goal is simply to understand the fundamental concept of what a stock represents. Chapter 6. Loaning your money. Understanding bonds. If stocks represent ownership, think of bonds as representing debt. When you buy a bond, you are essentially loaning money to an entity, which could be a company, corporate bond, or a government. Like U.S. Treasury bonds or municipal bonds issued by states or cities, imagine an organization needs to raise money for a specific project. Maybe a company wants to build a new factory, or a city wants to build a new school. Instead of going to a bank, they might issue bonds to the public. When you buy one of these bonds, you become a lender. How do bonds work? Typically, the entity that issued the bond promises to pay you, the bondholder, periodic interest payments over a set period. This interest rate is usually fixed. At the end of that period, known as the bond's maturity date, the issuer promises to repay the original amount of the loan, called the principal or face value. So think of it like you being the bank for that. Project. You lend them money, they pay you regular interest for using your money, and then they pay you back the original amount when the term is up. Compared to stocks, bonds are generally considered lower risk. Why? Because bondholders are creditors. If a company runs into financial trouble, it's legally obligated to pay its bondholders before its stockholders receive anything. Governments, especially major ones like the US government, are generally considered very reliable borrowers. However, this relative safety comes with a trade-off, as we learned earlier. Bonds typically offer lower potential returns than stocks over the long term. Their primary role in an investment portfolio for many investors, especially beginners, is often to provide stability, income through interest payments, and diversification. Meaning they help balance out the higher volatility of stocks. Of course, bonds aren't entirely risk-free. There's interest rate risk. If rates rise, existing bonds with lower rates become less attractive. Inflation risk, if inflation outpaces the bond's interest rate. And credit risk, the possibility the issuer could default on payments. Though this is less common with high-quality government or corporate bonds. But the core concept to grasp is this: bonds represent loans you make to companies or governments, typically providing fixed interest payments and return of principal. At maturity, generally offering lower risk and lower potential return compared to stocks. They play a valuable role in creating a balanced investment approach. Chapter 7. Baskets of investments, mutual funds and ETFs. Okay, we've talked about individual stocks, ownership, and individual bonds, loans. Buying these directly means you have to research and choose specific companies or bond issuers. For a beginner, that can feel daunting, and it also makes it harder to achieve diversification right away. Diversification simply means spreading your money across many different investments to reduce risk. Don't put all your eggs in one basket, as the saying goes. This is where mutual funds and exchange-traded funds, ETFs, come in. Think of them as pre-made baskets of investments. Instead of buying individual fruits one by one, you buy a whole fruit basket that already contains a variety of apples, oranges, bananas, and grapes. Mutual funds and ETFs pool money from many investors to buy a collection of stocks, bonds, or sometimes other assets. When you invest in a fund or ETF, you instantly own tiny pieces of all the investments held within that basket. This provides immediate diversification, which is a huge advantage for beginners. So what's the difference between mutual funds and ETFs? They are similar in purpose, but differ slightly in how they operate and are traded. Mutual funds. These are typically bought and sold directly from the fund company or through a broker at the end of the trading day, based on a price calculated once per day, called the net asset value or NAV. Some mutual funds are actively managed, meaning a professional manager tries to pick investments to beat the market, often coming with higher fees. Others are passively managed, simply aiming to track a market index, like the S&P 500. And these usually have lower fees. ETFs, exchange-traded funds. As the name suggests, ETFs trade on stock exchanges throughout the day, just like individual stocks. Their prices fluctuate during trading hours. Most ETFs are passively managed, designed to track an index, which generally results in very low fees. Because of their ease of trading and typically lower costs, ETFs, especially index-tracking ETFs, have become incredibly popular, particularly for beginners. For beginners, I often emphasize index funds, which can be structured as either mutual Funds or ETFs. An index fund simply aims to replicate the performance of a specific market index, like the S&P 500, which represents 500 of the largest U.S. companies. By buying an S&P 500 index fund or ETF, you instantly own a tiny piece of all 500 companies. It's a simple, low-cost way to get broad market exposure and diversification. The key takeaway: mutual funds and ETFs allow you to easily diversify your investments by buying a basket of stocks or bonds with a single purchase. For beginners, low-cost, passively managed index ETFs are often an excellent starting point due to their simplicity, diversification, and low fees. They remove the need to pick individual winners and losers. Chapter 8. Other starting points. Briefly, real estate and more. While stocks, bonds, and funds, ETFs, form the core building blocks for most beginner investment portfolios, it's worth briefly acknowledging a few other areas you might hear about. We won't dive deep here, as our focus remains on getting you started simply and effectively, but awareness is helpful. One common area is real estate. Owning physical property can be a significant investment, but it often requires substantial capital, time, and management effort. Being a landlord isn't passive. For beginners looking for real estate exposure without buying property directly, there are REITs, or real estate investment trusts. REITs are companies that own or finance income-producing real estate across various sectors: apartments, malls, offices, etc. You can buy shares of REITs on stock exchanges, just like stocks or ETFs. This makes investing in real estate much more accessible and liquid, easier to buy and sell, than owning physical property. REITs can offer diversification and potential income through dividends. You might also hear about things like commodities, gold, oil, cryptocurrencies, or collectibles. While these can be part of some investors' strategies, they often come with unique risks, higher volatility, and require specialized knowledge. For absolute beginners, I strongly recommend focusing on mastering the fundamentals of stocks, bonds, and funds first. These other areas are typically considered more advanced or speculative. It's also important to distinguish true investments from savings vehicles that might offer slightly better interest rates. High-yield savings accounts, HSAs, for instance, are excellent places for your emergency fund because they are safe, FDIC insured up to certain limits, and offer better interest than traditional savings accounts. However, their goal is capital preservation and earning a modest interest rate, not the significant long-term growth potential sought through investing in assets like stocks or bonds. They serve different purposes in your financial plan. So the main point of this brief chapter is awareness. Know that other investment types exist, like REITs, for accessible real estate exposure. But don't feel pressured to jump into everything at once. Keep your focus narrow initially. Master the core asset classes, stocks, bonds, and especially diversified funds, ETFs. Build your foundation there before considering more complex or alternative investments. Part 3. How do you actually invest? Taking action. Chapter 9. Choosing your path, brokerage accounts versus robo-advisors. Okay, you understand why investing matters, you've got your financial foundation hopefully shaping up, and you know the basic types of investments. The next logical question is, how do you actually buy these things? Where do you go? For beginners, there are two main paths to get started: using a traditional brokerage account or opting for a robo-advisor. Let's compare them to the key brokerage accounts. Think of a brokerage account as your gateway to the investment markets. Companies like Fidelity, Charles Schwab, Vanguard, or newer platforms like Robinhood or Webull offer these accounts. How it works: you open an account, deposit money, and then you choose exactly what investments to buy and sell: stocks, bonds, ETFs, mutual funds. It's a do-it-yourself, DIY approach. Pros: You have maximum control over your investment choices. You can pick individual stocks or bonds if you wish, though we recommend starting with diversified funds. Many major brokerages now offer commission-free trading for stocks and ETFs, making it very cost-effective. They also provide extensive research tools and educational resources if you want to learn more deeply. Cons. You are responsible for making all the investment decisions. This requires some research and confidence. It can feel overwhelming initially. If you're unsure what to choose, you also need the discipline to manage your portfolio and rebalance it periodically. We'll cover rebalancing later. Best for people who want hands-on control, are interested in learning about specific investments, and are comfortable making their own decisions. Also great for those prioritizing the absolute lowest costs, especially with commission-free ETFs. 2. Robo-Advisors. These are online platforms like Betterment, Wealthfront, or Acorns that use algorithms to build and manage an investment portfolio for you, based on your goals and risk tolerance. How it works: you sign up, answer questions about your financial goals, like retirement or buying a house, timeline, and how comfortable you are with risk. The Robo-Advisor then recommends a diversified portfolio, usually made of low-cost ETFs, tailored to you, and automatically manages it. This includes reinvesting dividends and rebalancing the portfolio as needed. Pros: extremely easy to get started. It's a hands-off approach, perfect if you feel overwhelmed by choice or simply don't have the time or interest to manage investments yourself. The automated diversification and rebalancing are key benefits. They often have low minimum investment requirements. Cons: you have less control over specific investment choices. You're trusting the algorithm and the platform's pre-selected ETFs. They charge an annual management fee, typically a percentage of your assets, e.g. 0.25% to 0.50%, which is on top of the underlying ETF fees, though those are usually very low. While convenient, this fee adds up over time. Compared to a pure DIY approach with free trades, best for beginners who want a simple, automated, hands-off experience. Ideal if you value convenience and automated management over having direct control, or minimizing fees to the absolute lowest level. So which path is right for you? If you like the idea of control, are willing to do a bit of learning, and want to potentially minimize fees further, a brokerage account, perhaps starting with just 1 or 2 diversified ETFs, might be best. If you prefer simplicity, automation, and are happy to pay a small fee for the convenience of having it managed for you, a robo-advisor is an excellent choice. There's no single right answer. It depends on your personality and preferences. The key is to understand these 2 main routes and choose the one that feels most comfortable and sustainable for you to actually get started. In the companion PDF, I've listed examples of reputable providers for both brokerage accounts and robo-advisors, along with links to their websites so you can explore them further. Your takeaway is to consider which approach aligns best with how you want to engage with investing. Chapter 10. Opening your first account. A step-by-step guide. Once you've decided whether a brokerage account or a robo-advisor feels like the better fit, the next step is actually opening the account. This process might seem intimidating, but it's generally quite straightforward, similar to opening a bank account online. Let's break it down into simple verbal steps. First, you'll gather some basic information. You'll typically need your social security number or taxpayer identification number, your contact information, address, phone number, email, your date of birth, your employment status, and possibly your employer's details. This is often a regulatory requirement. You might also be asked about your income, net worth, investment objectives like growth, income, speculation, and risk tolerance. Be honest here. It helps the platform meet regulatory requirements and, in the case of Robo-Advisors, tailor recommendations. Next, you'll choose the type of account you want to open. This is an important decision. The two main categories are taxable brokerage account. This is a standard investment account with no special tax benefits. You invest money you've already paid taxes on, post-tax dollars. Any income, dividends, interest, or profits from selling investments, capital gains, are generally subject to taxes each year. It's flexible. You can withdraw money any time, though selling investments may trigger taxes. Retirement accounts. These offer significant tax advantages to encourage long-term saving for retirement. Common types for individuals include traditional IRA, individual retirement account. Contributions might be tax-deductible now, reducing your current taxable income. Your investments grow tax-deferred, meaning you don't pay taxes on gains or income each year. You pay ordinary income tax on withdrawals in retirement. Roth IRA. Contributions are made with money you've already paid taxes on, post-tax. Your investments grow completely tax-free, and qualified withdrawals in retirement are also completely tax-free. This can be incredibly powerful. There are income limits to contribute directly to a Roth IRA, but check current rules as they can change. You might also have access to a 401k or similar plan through your employer. These often come with an employer match, free money, which is a fantastic benefit you should absolutely take advantage of if available, at least up to the match amount. Which account type should you choose? If you have access to a 401k with an employer match, contributing enough to get the full match is often the first priority. Beyond that, for long-term retirement savings, IRAs, traditional or Roth, are usually excellent choices due to their tax benefits. If you're saving for a goal before retirement, like a house down payment in 5+ years, or if you've maxed out your retirement accounts, a taxable brokerage account is the way to go. Don't let this choice paralyze you. Starting somewhere is key. Many people have multiple account types. For beginners focusing on retirement, a Roth IRA is often a great starting point if you qualify, due to the tax-free growth and withdrawals. Finally, you'll need to fund the account. Once the account is approved, which can sometimes be instant, sometimes take a day or two, you'll link your bank account, checking or savings, and transfer money electronically. Most platforms make this very easy. You can usually set up one-time transfers or recurring automatic transfers, which is great for implementing dollar-cost averaging. We'll cover that soon. That's essentially it. Gather info, choose the account type, consider retirement accounts first for long-term goals, and fund it. It might feel like a big step, but broken down, it's manageable. Don't hesitate to use the customer service resources of the brokerage or Robo-Advisor if you get stuck. They are there to help. The companion PDF has links to help you understand IRA contribution limits and income restrictions. Your action takeaway is to feel confident initiating this process. You can do this. Chapter 11. Understanding and minimizing costs. All right, you've chosen your path, maybe even opened your account. Before you jump into making that first investment, there's a crucial topic we need to address directly. Costs. Investment fees might seem small, often expressed as tiny percentages, but they can have a massive impact on your long-term returns, especially when amplified by compounding, or rather, when they detract from compounding. Think of fees as small leaks in your investment bucket. Over decades, even tiny leaks can drain away a significant amount of your potential growth. Let's break down the main types of costs you might encounter. Expense ratios for mutual funds and ETFs. This is an annual fee charged by the fund company to cover operating costs, expressed as a percentage of the assets you have invested in the fund. For example, an expense ratio of 0.50% means you pay $5 per year for every $1,000 invested. This fee is deducted directly from the fund's returns, so you might not see it as a separate charge, but it directly impacts your performance. This is why prioritizing low-cost funds, especially index funds and ETFs, which can have expense ratios of 0.10% or even much lower, like 0.03%, is incredibly important. Actively managed mutual funds often have much higher expense ratios, sometimes 1% or more. Trading commissions. This is a fee some brokers charge each time you buy or sell an investment, like a stock or ETF. The good news is that many major online brokers in the US have eliminated commissions for online trades of US stocks and ETFs, which is a huge win for individual investors. However, commissions might still apply for other types of investments, like some mutual funds or options, trading, or if you place trades via phone. Always check the commission schedule. Advisory fees. If you use a robo-advisor, you'll typically pay an annual management fee based on the amount of assets they manage for you, e.g. 0.25% per year. If you work with a human financial advisor, they will also charge fees, which could be asset-based, hourly, or a flat fee. Understand how any advisor you work with is compensated. Why do these seemingly small fees matter so much? Let's go back to compounding. If your investments earn, say, 7% per year on average, but you're paying 1% in total fees, your net return is only 6%. Over 30 or 40 years, that 1% difference can reduce your final portfolio value by potentially hundreds of thousands of dollars, depending on how much you invest. It's a staggering impact. Therefore, your mindset should be, control the costs you can control. You can't control market returns, but you can control the fees you pay. Your action takeaway is crystal clear. Always, check the fees before investing. Prioritize low-cost investment options, particularly low-expense ratio index ETFs or mutual funds. If using a broker, favor those with commission-free trading for the investments you plan to use. If considering a robo-advisor or human advisor, fully understand their fee structure and weigh it against the services provided. Minimizing costs is one of the most effective ways to maximize your long-term investment success. Chapter 12. Your first investment, making it simple. Okay, the moment has arrived. You've opened your account, funded it, and you understand the importance of keeping costs low. Now what? It's time to actually make that first investment purchase. This can feel like a big leap, but let's make it simple and straightforward. First, let's demystify the process of placing a trade. This just means instructing your broker or robo-advisor, though they usually handle this automatically, to buy a specific investment for you. If you're using a brokerage account, you'll typically log in, search for the investment you want to buy, using its name or ticker symbol, a unique code like VOO for the Vanguard S&P 500 ETF. Specify how much you want to invest, either a dollar amount or a number of shares, and confirm the order. You might see options like market order or limit order. A market order tells your broker to buy the investment immediately at the best available current price. For beginners buying highly liquid investments like major ETFs, this is often the simplest and most common option. A limit order lets you specify the maximum price you're willing to pay per share. Your order will only execute if the price hits your limit or lower. This gives you more price control, but means your order might not get filled if the price doesn't drop to your limit. For your very first investment, especially if you're buying a broadly diversified ETF and focusing on the long term, using a market order is usually perfectly fine and keeps things simple. Now the big question, what should that first investment be? Remember our discussion about diversification and low costs. For most beginners, an excellent starting point is a single, broadly diversified, low-cost index ETF. Examples include an S&P 500 index ETF, giving you exposure to 500 large U.S. companies. Total U.S. Stock Market Index ETF, even broader exposure to thousands of U.S. stocks, large, medium, and small. A Total World Stock Market Index ETF, diversifying you across U.S. and international stocks. Why start here? Because with one simple purchase, you achieve instant-wide diversification at a very low cost. You're not trying to pick winning stocks. You're simply participating in the broad growth potential of the market. This aligns perfectly with the principles we've discussed. A robo-advisor will essentially do this for you, selecting a mix of low-cost stock and bond ETFs based on your profile. The most important thing is to start, even small. Don't wait for the perfect time to invest. Market timing is notoriously difficult, even for professionals. Don't feel you need a large sum. Invest an amount you're comfortable with, maybe $50, $100, or whatever fits your budget after covering essentials and your emergency fund. The act of making that first investment overcomes inertia and builds momentum. So, okay, you've opened the account, you've transferred some funds. Now what? Let's make that first investment simple. Choose a low-cost, broadly diversified index, ETF, that aligns with your long-term goals. Use a market order for simplicity if you're comfortable with that. Click Buy. Congratulate yourself. You're officially an investor. Your action takeaway: make your first simple, diversified investment. Don't overthink it. Take the plunge. Action trumps perfection here. Part 4. Building your strategy and staying the course. Chapter 13. Diversification and asset allocation, your safety net. You've made your first investment. Fantastic. Now let's talk about how to structure your investments strategically for the long term. Two concepts are paramount here: diversification and asset allocation. Think of them as your financial safety net and blueprint. We've already touched on diversification, but let's solidify it. It means spreading your investments across various categories to avoid having all your eggs in one basket. If one investment performs poorly, others might do well, cushioning the overall impact on your portfolio. Diversification can happen at several levels across asset classes. This is the most crucial level. It means holding a mix of different types of investments that tend to behave differently, primarily stocks and bonds. Stocks generally offer higher growth potential but more volatility, while bonds offer more stability and lower potential returns. Having both helps smooth out the ride. Within asset classes, for stocks, this means diversifying across different industries: tech, healthcare, consumer goods, etc., and company sizes: large, medium, small. For bonds, it means diversifying across different issuers: government, corporate, and maturities. Buying broad index funds, ETFs, automatically achieves much of this within asset class diversification. Geographically, investing not just in your home country, but also internationally, provides further diversification, as different economies perform differently at different times. A Total World Stock Market ETF handles this automatically. Now, asset allocation is the specific mix of these different asset classes in your portfolio. It's about deciding what percentage of your money goes into stocks, what percentage into bonds, and potentially what percentage into other assets like cash, for short-term needs or stability. Your asset allocation is widely considered the most important factor determining your overall investment returns and risk level over the long term. Even more important than picking individual investments. How do you determine your asset allocation? It primarily depends on two things: your time horizon. How long do you plan to invest before you need the money? If your goal is decades away, like retirement, you can generally afford to take on more risk, i.e., a higher allocation to stocks because you have time to recover from market downturns. If your goal is closer, e.g., 5 to 10 years, you might want a more conservative allocation with a higher percentage in bonds to reduce volatility as you approach your target date. Your risk tolerance. How comfortable are you emotionally and financially with the value of your investments fluctuating? If market drops cause you significant anxiety, you might prefer a more conservative allocation, even with a long time horizon. Simple rules of thumb for beginners. While personal circumstances vary, here are some common starting points, not personalized. Advice, age-based rule. A very basic guideline used to be 100 minus your age as the percentage to allocate to stocks, e.g., a 30-year-old would have 70% stocks, 30% bonds. Many now adjust this to 110 or 120 minus your age to reflect longer lifespans and potentially lower bond returns, suggesting a higher stock allocation for longer. Simplified risk profiles. Robo-advisors often categorize investors as conservative, moderate or aggressive, assigning preset allocations, e.g., conservative might be 40% stocks, 60% bonds. Aggressive might be 90% stocks, 10% bonds. Think of your asset allocation like building a balanced meal for your financial health. Stocks are like the protein providing growth potential, while bonds are like the steady carbohydrates providing stability. You need the right mix for your specific needs and appetite, risk tolerance. Your takeaway: understand that diversification spreads risk, and asset allocation, your mix of stocks and bonds, is the key driver of your long-term risk and return. Have a basic idea of an appropriate asset allocation for your goals and timeline. Even a simple age-based rule or a robo-advisor's suggestion is a great starting point. This structure provides your portfolio's foundation. Chapter 14. Simple strategies for beginners. Consistency is key. Now that you have a sense of what to invest in, diversified funds, and how to structure your portfolio, asset allocation, let's talk about how often and how to invest moving forward. Complexity is the enemy of execution for beginners. Simple, consistent strategies are your best friends. Here are two powerful ones: dollar cost averaging and buy and hold. Dollar cost averaging, DCA. This strategy involves investing a fixed amount of money at regular intervals, e.g., monthly or bi-weekly, regardless of what the market is doing. Imagine investing $100 every single month into your chosen index ETF. Why it works for beginners: removes market timing. Guesswork. You don't have to worry about whether it's a good or bad time to invest. You just invest consistently. Reduces emotional decisions. When markets are down, fear might tempt you to stop investing. DCA forces discipline. When markets are high, greed might tempt you to invest more than planned. DCA keeps you steady. Averages out your purchase price. When prices are high, your fixed amount buys fewer shares. When prices are low, that same fixed amount buys more shares. Over time, this can potentially lower your average cost per share compared to investing a lump sum at a market peak. Builds the habit. It automates your investing, making it a regular part of your financial routine, like paying a bill. Most brokerage platforms allow you to set up automatic recurring investments, so buy and hold. This is less of a how-to-buy strategy and more of a long-term philosophy. It means buying quality diversified investments like those index ETFs and holding onto them for the long term, years, even decades, largely ignoring short-term market noise and fluctuations. Why it works for beginners. Leverages compounding. As we discussed, compounding needs time to work its magic. Buy and hold gives your investments that time, minimizes costs. Frequent trading can rack up potential, though less common now, commissions and, more importantly, can trigger taxes on capital gains. Holding long-term often qualifies gains for lower long-term capital gains tax rates, reduces stress. Constantly trying to time the market or react to news headlines is stressful and often counterproductive. Buy and hold allows you to tune out the noise and focus on your long-term goals. Aligns with historical trends. Historically, despite short-term volatility, diversified stock market investments have trended upwards over the long run. Buy and hold aims to capture that long-term growth. These two strategies work beautifully together. Use dollar-cost averaging to invest consistently and adopt a buy and hold mindset to stay invested through market ups and downs, focusing on your long-term plan. Your action takeaway is clear. Commit to a consistent investment schedule using dollar-cost averaging. Set up automatic transfers and investments if possible. Embrace a buy and hold philosophy. Focus on the long journey, not the daily bumps in the road. Consistency and patience are far more powerful than trying to be clever with market timing. Chapter 15. Riding the roller coaster. Dealing with market volatility. Investing, especially in stocks, isn't always a smooth upward climb. It's more like a roller coaster. There will be thrilling highs, but there will also be stomach-churning drops. Market volatility, meaning periods of significant price swings, corrections, typically defined as a drop of 10% or more, and even occasional crashes, steeper, faster drops, are a normal, unavoidable part of investing. Preparing yourself mentally for this reality is crucial for staying the course. When markets fall sharply, it triggers powerful emotions. Fear is the most common. Fear of losing money, fear that things will get worse, fear that you made a mistake. This fear can lead to panic selling your investments during a downturn, often locking in losses and missing out on the eventual recovery. On the flip side, when markets are soaring, greed can take over, tempting you to take on excessive risk or abandon your strategy to chase hot trends. Here's what I've learned over years of experience and observation. Your reaction to volatility is often more damaging to your long-term returns than the volatility itself. Making impulsive decisions based on fear or greed is one of the biggest destroyers of wealth for individual investors. I've seen investors make costly mistakes by panicking and selling at the bottom, only to watch the market recover without them. So how do you handle the roller coaster? Acknowledge it's normal. Understand that market downturns have happened repeatedly throughout history, and historically, markets have always recovered and gone on to reach new highs. Seeing volatility as a feature, not a bug, helps normalize. It focuses on your long-term plan. Remember why you started investing in the first place. Is your goal still years or decades away? If so, short-term drops are just noise on the path to that long-term goal. Stick to your asset allocation and consistent investment schedule, DCA. Avoid checking your portfolio obsessively, especially during volatile times. Constantly looking at your balance can amplify anxiety and increase the temptation to react emotionally. Set a schedule for review, maybe quarterly or annually, but resist the urge to check daily. Reframe downturns. If you have a long time horizon and are still investing regularly using DCA, market downturns actually mean you're buying shares at lower prices. Essentially, things are on sale. This perspective can help shift fear into a sense of opportunity within your planned contribution amounts. Trust your diversification. Remember that diversification is designed to cushion the blows. While some parts of your portfolio might be down, others might hold up better. Yes, it feels uncomfortable when markets drop. Acknowledge that discomfort, but rely on perspective, your plan, and discipline, not emotion. The investors who succeed long-term are typically those who remain calm and stay invested during turbulent times. Your takeaway: develop resilience to market volatility. Understand it's normal, focus on your long-term goals, stick to your plan, and crucially, avoid making investment decisions driven by fear or greed. Your disciplined behavior during downturns is key to long-term success. Chapter 16: Taxes and Investing. The basics. You need to know. Taxes are an unavoidable part of life, and they also play a role in investing. Understanding the basics can help you make smarter decisions and potentially keep more of your returns over the long run. Now, let me be very clear up front. I am not a tax advisor, and this information is for educational purposes only. Tax laws can be complex and change over time, and your personal situation is unique. For specific tax advice, always consult with a qualified tax professional. That said, let's cover the key concepts beginners should be aware of. Taxable versus tax-advantaged. Accounts. Recap. We touched on this when opening accounts, but it's worth reiterating because it's the most significant tax consideration for most investors. Taxable brokerage accounts. Investments here grow, but you generally pay taxes along the way on dividends and interest received each year, and on capital gains when you sell investments for a profit. Tax-advantaged retirement accounts, traditional IRA, 401k, Roth IRA, 401k. These accounts offer powerful tax benefits. Traditional, potentially tax-deductible contributions now, tax-deferred growth, no taxes year to year, taxed as ordinary income upon withdrawal in retirement. Roth, contributions with after-tax dollars, completely tax-free. Growth, and completely tax-free qualified withdrawals in retirement. The takeaway: prioritizing contributions to tax-advantaged accounts, especially for long-term retirement goals, is usually the most effective way to minimize the impact of taxes on your investment growth. Max out these options first if possible, particularly if your employer offers a 401k match, capital gains tax. When you sell an investment in a taxable account for more than you paid for it, that profit is called a capital gain, and it's generally taxable. The tax rate depends on how long you held the investment. Short-term capital gains. If you hold an investment for 1 year or less before selling, the gain is typically taxed at your ordinary income tax rate, which is usually higher. Long-term capital gains. If you hold an investment for more than 1 year before selling, the gain is typically taxed at lower long-term capital gains rates. The takeaway: this highlights another benefit of the buy and hold strategy in taxable accounts. Holding investments long-term not only aligns with long-term goals, but can also result in lower tax rates on your profits when you eventually sell. Dividends. If your investments, stocks or funds, pay dividends in a taxable account, these are generally taxed in the year you receive them. Qualified dividends. Most common dividends from U.S. stocks and funds are typically taxed at the lower long-term capital gains rates, while non-qualified dividends are taxed at ordinary income rates. Again, this is a simplified overview. Tax. Rules have nuances regarding specific investment types, state taxes, and individual circumstances. The key point for beginners is to understand the significant advantage of using tax-advantaged retirement accounts whenever possible for long-term goals. For investments held in taxable accounts, be aware that selling triggers potential taxes, and holding for the long term can be beneficial from a tax perspective. Your takeaway: understand the basic difference between taxable and tax-advantaged accounts and prioritize the latter for retirement savings. Be aware of capital gains taxes in taxable accounts and the potential benefit of holding investments long-term. Remember to consult a tax professional for personalized advice. Chapter 17. Avoiding common beginner mistakes. Knowledge is power, and sometimes knowing what not to do is just as important as knowing what to do. As a beginner investor, you're likely to encounter pitfalls that have tripped up many before you. By being aware of these common mistakes, you can actively work to avoid them. Let's run through some frequent ones. Trying to time the market. This is probably the most common and costly mistake. Thinking you can consistently predict market highs and lows, to buy low and sell high, is incredibly difficult, even for professionals. More often than not, attempts at market timing lead to missing out on gains or selling at the wrong time. Remember, our strategy: dollar cost averaging and buy and hold. Consistency beats timing, letting emotions drive decisions. We talked about this with volatility. Making investment choices based on fear during downturns or greed during rallies is a recipe for poor results. Stick to your rational, predefined plan. I worked with someone once who sold everything during a market dip, convinced it was the end of the world, only to miss a massive recovery over the next year. Emotional decisions are rarely profitable. Chasing hot tips or past performance. You might hear a friend raving about a stock that doubled or see a fund that had amazing returns last year. Resist the urge to chase these hot investments. Past performance is not a guarantee of future results, and tips are often unreliable. Stick to your diversified, low-cost strategy rather than jumping on bandwagons. Ignoring fees. As we discussed, even small fees significantly erode long-term returns. A common mistake is choosing a fund or platform without understanding or comparing the expense ratios, advisory fees, or potential commissions. Always check the costs. Not diversifying enough, putting too much money into a single stock, maybe your employer's stock or that hot tip, or even a single sector, is risky. If that one investment falters, your portfolio takes a major hit. Broad diversification across asset classes, industries, and geographies is your safety net. Index funds make this easy. Analysis paralysis. Failure to start. Some beginners get so caught up in researching every possible option and fearing making the wrong choice that they never actually start investing. Remember, starting small with a simple, diversified approach is far better than waiting indefinitely for perfect knowledge or the perfect moment. Overcome inertia. Not having clear goals. Investing without knowing why you're investing makes it hard to determine the right strategy, asset allocation timeline, and harder to stay motivated during tough times. Define your goals, retirement, house down payment, etc., and time frame first. Recognizing these common mistakes is the first step to avoiding them. Focus on your long-term plan, diversification, low costs, consistency, and emotional discipline. Learn from the common errors others have made. Your takeaway: actively watch out for these pitfalls. Recognize when you might be falling into one of these traps, especially emotional reactions or chasing trends, and consciously steer back to your simple, disciplined strategy. Part 5. The Long View and Next Steps. Chapter 18. Reviewing and Adjusting Your Plan. Simply, investing isn't a set-it-and-completely-forget-it activity, but it also doesn't require constant tinkering, especially if you've set up a simple, diversified strategy. However, periodic reviews and occasional adjustments are necessary to ensure your plan stays aligned with your goals and circumstances. The key here is to keep this process simple and manageable. When should you review your plan? 4. Most beginners with a long-term strategy, a full review once a year is often sufficient. You might also want to review if you experience a major life change, such as getting married, having a child, changing jobs, especially if it impacts income or retirement plan access, or getting closer to your financial goal, like nearing retirement. Avoid reacting to short-term market news. Schedule your reviews intentionally. Maybe set a calendar reminder for the same time each year. What should you check during your review? Progress towards goals. Are your consistent contributions helping you move towards your long-term objectives? Is the overall plan still appropriate for your goals? Asset allocation. This is the most important check, because different asset classes grow at different rates. Your initial mix, e.g., 70% stocks, 30% bonds, will naturally drift over time. For example, if stocks have performed well, they might now represent 80% of your portfolio, making it riskier than you originally intended. Investment choices. Less frequent. Are your chosen funds, just ETFs, still low cost and broadly diversified? Unless something fundamental has changed about the fund, you likely don't need to switch investments often, especially if you started with broad index funds. Avoid chasing performance. Fees. Briefly confirm the fees you're paying haven't unexpectedly increased. Rebalancing. Getting back on track. If your review reveals that your asset allocation has drifted significantly from your target, e.g. more than 5 to 10% off, you may need to rebalance. Rebalancing simply means buying or selling investments to bring your portfolio back to its original desired mix. How to do it simply? Use new contributions. The easiest way is to direct your new investment contributions towards the asset class that is underweight. For example, if stocks have grown and bonds are now below your target percentage, put your next few contributions entirely into your bond fund until the balance is restored. This avoids selling and potential taxes in a taxable account. Sell high, buy low, less frequent. If directing new contributions isn't enough, or you need to rebalance more significantly, you might sell some of the overweight asset class, which has performed well, and use the proceeds to buy more of the underweight asset class. Be mindful of potential tax implications if doing this in a taxable account. Robo-Advisors. If you use a robo-advisor, they typically handle automatic rebalancing for you, which is one of their key convenience features. The goal of reviewing and rebalancing isn't to constantly chase returns, but to manage risk and keep your portfolio aligned with your long-term strategy. Keep it simple and systematic. Your takeaway: plan to review your investments periodically, perhaps once a year or after major life events. Focus primarily on checking if your asset allocation aligns with your target and rebalance gently, preferably using new contributions if needed. Don't overcomplicate it. Chapter 19. Creating your simple investment plan. We've covered a lot of ground, from the fundamentals to practical steps and long-term strategies. Now, let's bring it all together by outlining how you can create your own simple personal investment plan. Writing this down, even just a few key points, makes your intentions concrete and provides a roadmap to follow. Think of this as your personal investing blueprint. Here are the key components to define for your simple plan. Step 1. Define your goal as and time frame. What are you investing for? E.g., retirement, a house down payment, general wealth building. When do you estimate you'll need the money? E.g., 30+ years for retirement, 7 years for a down payment. This determines your time horizon. Step 2. Assess your risk tolerance. Simply, honestly, how comfortable are you with seeing your investment value fluctuate? Choose a simple profile: conservative, prefer stability, lower potential returns; moderate, balanced approach; or aggressive, seek higher growth, comfortable with more volatility. Step 3. Determine your target asset allocation based on your time frame and risk tolerance. Decide on a basic mix of stocks and bonds. Use a simple age-based rule, e.g., 110 minus age, 9% stocks. Align with a suggested profile: conservative, moderate, aggressive, or use the allocation recommended by a robo-advisor if you chose that path. Write it down, e.g., target 80% stocks. 20% bonds. Step 4. Choose your account type as. Where will you invest? Prioritize employer match in a 401k first. Then consider IRAs, Roth or traditional, for retirement goals. Use a taxable brokerage account for other goals or after maxing retirement accounts. Note which accounters you will open or use. Step 5. Select your initial investments. Keep it simple. Choose one or two broadly diversified low-cost index funds or ETFs that match your asset allocation. For example, if your target is 80% stocks, 20% bonds, you might choose a total US stock market ETF for 80% and a total US bond market ETF for 20%. Or even simpler, a target date fund, available as mutual funds or ETFs, automatically adjusts its stock-bond mix over time based on your chosen retirement year. Write down the specific funds, ETFs, you plan to use. Check their low expense ratios. Step 6. Decide your contribution amount and schedule. How much can you realistically invest regularly, e.g. monthly, after covering essentials and building your emergency fund? Commit to a schedule, e.g. $150 on the first of every month. Set up automatic transfers and investments if possible to implement dollar cost averaging. Step 7. Plan for review. Note down when you plan to review your portfolio, e.g., review annually in January. That's it. 7 simple steps to create your basic investment plan. It doesn't need to be overly detailed, just clear enough to guide your actions. To make this even easier, I've included a simple investment plan template in the companion PDF that you can fill out. Your action takeaway. Take the time to actually draft your personal, simple investment plan using these steps or the template. Write it down. This act of planning solidifies your commitment and provides clarity for moving forward. Conclusion: your financial future is in your hands. We've reached the end of our journey together in Investing for Beginners, a simple guide to growing your money. We started by acknowledging the potential overwhelm and demystifying the core concepts. We explored why investing is crucial, tackled the mindset hurdles, and laid the essential financial foundation. We decoded the main investment types, stocks, bonds, and the power of diversified funds like ETFs. We walked through the practical steps of opening an account, minimizing costs, and making that important first investment. And finally, we focused on building a simple, sustainable strategy through diversification, asset allocation, consistency, and emotional discipline, while preparing for the long view. If there are just a few core principles I hope you take away, they are these. Investing is accessible to everyone, not just the wealthy or financial experts. The power of compounding returns over the long term is your greatest ally. Start early and stay invested. Consistency beats attempts at market timing. Dollar cost averaging and buy and hold are simple yet powerful strategies. Controlling what you can control, namely costs, fees, and your own emotional reactions to market volatility, is critical for success. Simplicity is key, especially when starting out. A straightforward plan executed consistently is far better than a complex one you abandon. You now have the foundational knowledge and the tools to take control of your financial future. You understand the why, the what, and the how of getting started with investing. The path is clear. The steps are manageable. I genuinely believe, having guided many others, that you possess the capability to implement these strategies and begin growing your money effectively. But knowledge alone isn't enough. The journey truly starts with action. That initial inertia can be the biggest barrier. So my final encouragement is this: take that first concrete step, no matter how small it feels. Open that account. Make that first transfer. Purchase that first share of a diversified, low-cost ETF. Your financial future is not predetermined. It is shaped by the decisions you make and the actions you take, starting today. You have the power to build a more secure and prosperous future for yourself. So I urge you, open that account. Make that first investment. Start growing your money today. Don't forget the glossary, checklists, links, and that simple investment plan template are there to support you as you move forward. You can find the link in the audiobook description. Thank you for joining me on this journey. I hope you feel more confident, informed, and empowered. I wish you the very best as you take these steps towards building your financial future. Investing for Beginners, a simple guide to growing your money. Fast audiobook. Introduction. Your journey to growing your money starts here. Written by Peter A. Saul. Published by Audiobooks LOA.